Most people think building wealth is about choosing between two options, real estate or the stock market. But that's the wrong way to frame the problem. The real question is not which is better. It is, which builds wealth faster for your situation, capital, and risk tolerance. Let's break it down without bias. 1. Core difference, asset control versus liquidity. Real estate gives you direct control. You buy a physical asset, land or property, and you can improve it, rent it, or leverage it. The stock market gives you fractional ownership in companies. You don't control the business, but you benefit from its growth. So the first strategic split is real estate equals control plus leverage, stocks equals liquidity plus diversification. 2. Capital requirement, high entry versus low entry. Real estate usually requires high upfront capital. Even a single property often needs down payment, closing costs, and maintenance. In contrast, the stock market allows you to start with very small amounts and still build a diversified portfolio instantly. This creates a key insight. Real estate builds wealth slower to start, but stronger per asset. Stocks allow faster entry and scaling with small money. 3. Returns. Cash flow versus compounding. Real estate generates income through rent and long-term appreciation. You can also use leverage, loans, to amplify returns. Stocks grow mainly through compounding returns and dividends, especially in strong index funds. Historically, broad stock markets like the S&P 500 have delivered strong long-term growth due to continuous reinvestment and business expansion. 4. Risk profile, stability versus volatility. Real estate is generally more stable. Prices move slowly, and physical demand, housing, is always present. But it is less liquid. You cannot sell instantly. Stocks are highly liquid but more volatile. Prices can move sharply in days or even hours due to market sentiment. So, real estate equals stability with lower liquidity. Stocks equals volatility with high liquidity. 5. Leverage, hidden wealth. Accelerator. This is where real estate has a unique advantage. In real estate, you can use borrowed money, mortgages, to control large assets with relatively small capital. In stocks, leverage exists but is riskier and less commonly used for long-term investing. This means real estate can accelerate wealth if managed correctly, but also increases risk if markets turn. 6. Time and effort. Real estate is active. It requires management, tenants, repairs, and decision-making. Stocks are more passive. Once invested in diversified funds, they require minimal maintenance. So your choice also depends on time availability, interest in active management, willingness to handle operational work, strategic insight. Here's the key truth most people miss. Real estate builds wealth through leverage, plus inflation, plus physical demand. Stocks build wealth through compounding, plus scalability, plus liquidity. So the question is not which is superior universally. It is which system fits your wealth stage. If your goal is fast scalability with low entry capital, the stock market has an advantage.